Yo, yo, what up, Toastie?
What's up, Norman? How are you?
Good, brother. How's everything?
Good, dude. I'm traveling today, so I'm working off a laptop, so it's gonna be a little clunkier. So I don't know how it's gonna go, but
What up, Toasty? Good evening, bro.
hey, Rob, it's good
Yo,
to see you.
yo, remember Roblox? It was like at 100. It went up another $20, bro.
It's at 120.
It's almost to 130 for it's pretty much almost at its all-time
What
high, but
what name is that?
That's
Roblox
Roblox.
vertical.
That's so shocking, bro. Some of these things you just really can't explain.
Y'all looking at this new program, Toastie? I don't know if you heard about it. It's called TC 2000.
I have heard about it.
Isn't Roblox like swarmed with sickos?
What do you mean, sickos?
I've seen a few different videos over the last like year
Oh,
where like
I just
like predators be like on there,
You know what
talking
I
to
know about
kids.
Roblox? Like the people that can't do like stuff in real life, they'll hang out in Roblox and go to the club and shit, you know? It just makes them feel better, you know? It's that type of stock.
that's disgusting. I doubt that's that common, though, to be honest with you. Like, I'm sure it happens, but dude, it can't be that popular, right?
Yo, I just downloaded the other day, Toasty. Bro, you wouldn't believe it. There's like 120 different type of different games, bro, you can play.
I I can imagine, dude. It's a kids game, so they got to keep the kids excited. What's going on, SK? Thanks for coming out. Yeah, I don't doubt it, Norman. I'm sure Roblox is a fascinating universe. We're gonna get started here in just a couple of minutes because I got
Let's get
started
it.
a couple minutes late in the first
We
place.
got a trade deal with Japan, huh? I see SPY is going up.
I haven't even had the opportunity to see anything that really went on today until right before this lecture. I've been
I've been
I don't
I've
know if
been
you're in your
I've been on Wells Fargo, yo. I took a swing trade yesterday. And you won't believe it today, Toasty. They ran up 440%, the $82 call from $18 to a dollar, bro.
what are you swinging, dude? Weeklies?
Yeah, like 2 weeks out.
Okay, all right, that's not as bad. All right, we're going to get started in just a couple of minutes. You guys will probably notice some slight differences. I'm on the laptop today, so it might be a little clunkier than everybody's used to, but hopefully it's not too big of a deal. Um, but tonight should be a fun one. It was exciting for me to prepare for this class. It's different than probably any other candlestick lecture you've ever seen or even thought you've seen. So I'm interested to see what you guys think. I'm really doing everything I can to keep things nice and intermediate slash advanced for us in these classes. So we'll see how it goes. We'll give it like 1 or 2 more minutes and then get started. I'll probably send one more message out, letting everybody know we're getting started. You guys doing good tonight?
Yeah, man, doing good.
Good. Hopefully this gets you a little more fired up. There was as I was preparing for this lecture, there was like multiple textbook examples that I saw immediately. So I'm I don't know. I'm always excited when that happens. All right. I think we've sufficiently let everybody know what's going on. So I say we get into it, and we'll see who stops by later. Um, all right, everybody. Welcome to the second lecture of the beginners course series. Like I mentioned a little bit ago, probably hopefully everybody's heard of it at this point, but I'm on a laptop today, so things might be a little bit different, a little bit clunkier, but I'm going to do my best to keep things as nice as possible. But you'll probably notice some weirdness as we go throughout the presentation, so I apologize for that in advance. Um, Yeah. How many of you were in the previous intermediate course series lecture? That was last week, last Tuesday. Is this anybody's first lecture
I was
of the
there.
course? Well, I couldn't have forgotten that. Anybody new to the intermediate course series?
Yeah, I was there too.
Cool. We got Maria, new, welcome. But not too many people seem like they're new tonight. So that's overall a good thing. But we'll still give a quick kind of reminder on where we're at in the course and where we're headed. So let's get into that. Hopefully this works the way I wanted it to. Okay, so as a reminder, the intermediate course series is going to be a 12 lecture course. It's all new content. In general, it's all going to be stuff that you've never seen before, at least from me. And we're here on week 2. And today we're going to talk about candlesticks. And hopefully you saw in the alert when I mentioned kind of what this lecture was going to be about. But long story short, this is not going to be your typical lecture on candlesticks. We're not going to be talking about how to know if something's a hammer, how to know if something's a bullish engulfing. We're not going to tell you about the highs and lows of candlesticks because this is to be a little bit more intermediate focused. Instead, we're going to focus a lot more on some really fascinating applications of candlestick patterns, as well as some introduction into some price action analysis. So long story short, it's going to be, in my opinion, this is one of the favorite lectures that I've ever developed. It was fascinating for me to even prepare the content for this one. Even did a little bit of studying myself to get ready. So hopefully you guys feel the same way. Yeah, it looks like some of you have all been here. Nick asked when FaZe is guest speaking. I'm hoping to have FaZe in lecture 10 on trading psych. And I also messaged River to see if he was interested tonight, but I don't think he was super available. So I'm not sure he'll be able to make it. And as a reminder, 2 main goals for the intermediate course series are as follows. First and foremost, the goal is to improve the skills of traders who have a baseline understanding of technical analysis and stock market basics. So again, as we mentioned in the previous lecture, this course series isn't going to be giving you kind of the basics, right? We're not going to talk too much about, what is a bull flag and what is a bull hammer, that sort of thing. We want to focus a little bit more on higher level concepts, things that are a little bit more difficult to understand, and concepts that take some experience and some knowledge to truly grasp. And the second most important goal is going to be to teach you all how to apply these techniques. So we're not just going to talk about theory, we're not just going to talk about ideas, but we're going to focus a lot on real world applications. Typically, I like to have some quiz questions in the lecture as well. I know I said last time that I would have them in this one, but I didn't do it because it just didn't make too much sense for the content. But whenever it makes sense, we'll be doing some quiz questions. We'll do some interaction and see kind of gauge your guys' thoughts and where you're all at. And that's the big idea for the course. So with that, I wanted to start with a quick recap of the topics that we covered in our last lecture for those of you who either were there or missed it. Hopefully this helps kind of jog our memory on where we're at in the course. Throughout the series, we'll continue to do these recaps. In my mind, it's a good way to make sure we're retaining the information that we talk about. Obviously, it's on you to continue studying and making sure you remember them, but hopefully a little bit of forced recall when we cover it at the beginning of each lecture will help a little bit. So, before I get too far into it, any questions before we get started? Go back one.
Yeah, I have a question, Toasty. Yo, I'm pretty stoked about this, man. I've been to all your lectures like the past 2-3 years, and this is the newest one, so I'm really stoked about learning.
That wasn't a question, that was a comment, but I appreciate it, Norman, and it's good to have you here.
Tostie's lectures and River's lectures are the best, bro.
Thank you, Rob. We appreciate it. River has great lectures too. I need to make more of an effort to attend his, to be honest with you, because he's taught me so much. Tilio's taught me so much, and it's overall a good group. Okay, let's talk about what was covered in the last class. So last time we talked a lot about market structure, and the way we define market structure is the framework of swing highs and swing lows that define market trends. So let's get straight into an example that covers that a little bit more closely. So here we have the recent price action on the S&P over the last year. And starting off on the left, we can consider this our initial kind of low or reference point. And we talked about having that initial reference in the prior lecture. Continuing further, we have our initial swing high or higher high in this case. And then from there, we can see there is plenty other subsequent higher highs and higher lows, which obviously means that this chart is very clearly in an uptrend. Now, one thing to note is as of recent price action, there's one thing that's pretty clearly left out of this example, which is this higher low, or excuse me, lower low here. I'm already stumbling over my words. And the way we discussed this last time is these higher highs or higher lows or shifts in potential trends are that first warning sign that trend is beginning to shift. And as price action traders, as traders who are focused on the technical side of things, it's very important for us to always understand the direction of the trend because no matter what, no matter if we're long or short, as long as we're trading with the direction of the overall trend, we're always going to have a higher probability of being right. When market has the momentum in the direction that you're looking to take a trade, you have that as a tailwind in any trade that you enter into. And the important thing to note about this specific lower low is that obviously it was the short-term bottom in the market as we saw just a few months ago. But additionally, right, if we look a little bit closer, which we did in the last lecture, we can see a small downtrend in this section here. Hopefully you guys can see my mouse okay. We can see a small downtrend in this kind of shorter term section of the chart. And this sort of trend analysis can be done on all sorts of time frames. The important thing to note is that the trends on the highest time frames are always going to be more important than the trends on the lower time frames. However, in this specific case, we did a deep dive into this specific example here. You have a pretty clear lower high right where we previously had that higher low. And if you look at this example here, which I didn't have that level perfectly drawn out, those prior pivots in the trend can be very key levels of support and resistance. And these levels are really important for us to monitor as price action traders because from a, I guess, psychological or overall market perspective, more traders are going to be looking to long when the market is bullish. And once we get this shift into a more bearish short-term structure, it's going to be a lot harder to be on the long side of any trade. So it's important, kind of as we talked about last time, to make sure you're on the right side of these trades, to make sure you're understanding the overall structure of the market. And obviously this is on the S&P, but it's important to not only understand the overall market, but also the individual stock that you're trading. If the overall market is in a clear bull trend and the individual stock that you're looking at has been in a bear trend and is not setting any higher high or higher low, it's probably not the best opportunity, at least in the short term, for you to get involved with. And that was another thing that we covered in the last lecture. We talked a lot about focusing on relative strength and relative weakness. And the first example that we referred to was this Apple chart here. And with this Apple name, you could see in general, the chart looks reasonably similar to the S&P chart that we looked at before, where it has pretty clear sequential higher highs and higher lows all throughout 2023, 2024. And once we got that bear market just a couple months ago, it hasn't really recovered to start setting some significant higher highs. So this is going to be an example of a name with relative weakness, right? As a typically shorter term options trader, right, you're going to be looking for the names that stand out the most in terms of relative strength. And Apple would be a great example of a name that has recently stood out with relative weakness, right? If we look back at our prior example, if my laptop lets me eventually, we can see pretty clearly, right, SPY has set a new all-time high, whereas Apple is not even looking close to similar, right? It's set multiple lower highs ever since it hit its most recent all-time highs. And the reason that we covered this example was to highlight the fact, again, as shorter term traders, right, not necessarily long-term investors, but as shorter, 1 to 3 month time horizon traders, typically it's going to be best for us to look into names that are showing the most strength above other names in the marketplace, right? And I believe we talked about the example or analogy or whatever you want to call it, like an elephant in a bathtub, right? You could think of a large fund or sometimes referred to as smart money or just some capital investment group with large amounts of money buying into a stock as an elephant in a bathtub, right? It's very difficult to hide the fact that the elephant's in the tub. You can very clearly tell. Yes, Norman.
Would that be like a Goldman Sachs since financials, any pullback, you see that elephant in the tub, like you're saying right now?
Yeah, absolutely. Yeah, that would be one example of that type of firm. Yeah, it could be a Goldman. It could be even smaller firms that are trading in amounts of billions. But in general, that's absolutely correct, right? Those are going to be the firms that actually have impacts on the market. And the reason that this matters is because the firms that have an impact on the market are the reason that we get these breakouts and the reason that we set these higher lows. Because these names step in, or excuse me, those firms step in at lows to begin buying a stock. And once we see the trend shift from higher highs and higher lows, or an uptrend, to start seeing these lower highs and lower lows, the idea is that now these large funds are beginning to sell highs rather than buy lows. So it's our responsibility to basically identify that in the chart. Does that make sense, Norman?
Yeah, yeah, and I was actually taking a look, like kind of like pretty much similar names with large funds of like capital, like as you were just mentioning, and they have the same exact chart. Pretty much Morgan Stanley, Charles Schwab, Citibank, Wells Fargo. Any dip on those names, like they literally have legs higher, but it's
Mhm.
just being patient with your swings.
Yeah, that can absolutely be part of it. We're going to keep rolling, Norman, but I appreciate it. It's a great point. So to summarize the market structure piece that we covered last time, market structure can be used for a couple different pieces when you're basically setting up a trade or analyzing charts. Obviously, as we talked about a lot, understanding market structure indicates the direction of an uptrend. So any sequence of higher highs and higher lows makes it expressly clear that all buyers are in control. And kind of as we mentioned before, each higher high basically shows that those large institutions, or elephants in a bathtub, whatever you want to refer to them as, show that their demand is strong enough to overcome the previous selling pressure at prior highs. So I just realized I can't pull up a chart. But if we look back to these prior highs, for example, from July of 2024 on Apple, I know it's probably a little bit hard to see when I'm on the laptop. Previously, we had a lot of selling at this spot. But ultimately, the buying pressure of large institutions overwhelmed the selling pressure at these same levels, which ultimately resulted in a higher high. So that's why we care about that. Also, as we mentioned, each higher low shows that buyers are willing to step in earlier than before. Another way to think about this is, let's say, for example, I love the PS5 example, so we'll go with that. Let's say, for example, the PS5 is currently priced at $250, and some people start buying the PS5, and maybe the price goes up to $300. And then all of a sudden, people keep buying the PS5. Basically, what that shows is continued demand as the price of a, we'll say, fixed value asset gets higher, right? For some reason, large buyers are interested in buying the price of an asset as the price goes higher. And hopefully we all know by now that as a stock price increases, that basically means that the overall value of the company also increases. So you're paying more to get a little bit less. You're getting a smaller fraction. Well, that's not exactly true. You're basically paying more for the same piece of the company. So it's like a reverse sale. Also, market structure indicates continuity of the trend. So as long as these higher highs and higher lows are maintained, the uptrend remains intact. And same idea, if we were in a downtrend, right, we'd be seeing lower highs and lower lows. And as long as those are maintained, the downtrend would remain intact. And as we mentioned, breaks in structure, like failing to make a higher high or failing to make a higher low, begins to signal trend weakening or reversal. And we saw this pretty clearly here on Apple, right? This first lower high was all the way up at 250, and we failed to make another lower high here around 220, and ultimately prices hit, we failed to make a higher high after topping out at 220, and ultimately prices went all the way down to 270, 170, and have continued to not set a new high. And a couple more things to cover. These higher lows, higher lows, higher highs, whatever you want to call them, these pivots and trends can be very logical stop losses, right? Because a break above a higher high or a break above a higher low or whatever the scenario may be is an incredibly logical stop loss, right? So for example, if we're in an uptrend and we break below the previous higher low, we're beginning to shift into a potential downtrend. And even if we're not shifting into a downtrend, we're at least starting to get weakening uptrend. So obviously an important point for us to be mindful of as we're trying to manage our trades. And if the trend is a core piece of our trade idea, which it always should be, that would definitely be a red flag. So I really blasted through that. Had to take a deep breath at the end there. That was everything that we covered last lecture in 15 minutes. Obviously, we abbreviated a lot, but I can't stick around too much on this topic because we still have a lot to cover tonight. But just because I'm curious, any questions or comments on market structure? If there's any easy ones, we could probably take those tonight, but any more complex ones, I'll probably refer you to just watch the prior lecture because I'm hoping we already answered them when I had a little bit more time. But any thoughts, questions, concerns? As for those who were in the market structure lecture last week, is that ringing some bells for us?
It is for sure.
Cool. Thank you, Robson. I saw you got disconnected. So
I was
back.
about to say, drink some water too, by the way, and then you already.
I just did. I just. Damn it, dude! I
it.
forgot about that. I forgot we were doing that last week.
Yeah.
Thank you, bro.
Yes, sir.
Not right now, Norman, but we can check that later. All right. So let's get into candlesticks. And I hyped this section up a lot, so hopefully it lives up to the hype and doesn't disappoint. But we'll see what you guys think. Ultimately, it's up to your own opinion. So I did mention that this isn't going to be a lecture on just the simple, candlestick patterns and that sort of thing. But I feel like I'd be doing you guys all a disservice without at least bringing up this graphic. This, in my mind, this specific graphic is more important than any candlestick pattern. It doesn't matter if you go and memorize all the names of all the silly candlestick patterns. That's all irrelevant, in my opinion. This specific graphic, not necessarily this one, but this concept is the most important thing to understand when you're thinking about the basics of candlesticks. And the idea behind this graphic is that at the left side here, we have a bull bar, which is going to be referred to a lot in this lecture. So when I say bull bar, I mean a bullish candle, a green candle, a candle where the price increases, whatever you want to call it. And when I say a bear bar, I mean a bearish bar, a red bar, a bar that closes near its low, that sort of thing. So on the left, we have a bull bar closing near its high with basically no wick. And what this indicates is that buyers were strong throughout the entire period of this candlestick, and there was virtually no sellers. And as we move to the right side of the graphic, we begin to notice more wicks on both sides of the bar. And ultimately, the weakest bar here is a bull bar that closes basically exactly where it opened with a long upside wick. And what this indicates is a potential shift in trend, right? This is where we're starting to see a lot of selling pressure begin to enter the marketplace. Bulls are still making some progress, right? Which is able to be determined based on the closing price over the open price. So we made a small increase from the bull side. However, it's very clear that selling pressure is beginning to enter the marketplace. And same thing goes for the bear bars, right? On the left side, we have basically an incredibly strong bear bar closing near its low with virtually no wicks. This indicates that sellers were strong the entire time and basically nobody was willing to buy. And as we transition towards the right side of the graphic, we get longer and longer wicks on both sides of the bar and ultimately have a very long downside wick, which indicates that at some point during the bar, or at least before it closes, a large amount of buying pressure took place, which signals a potential change or weakness in trend. So long story short, the bars on the left indicate really strong trending price action, and on the bars on the right indicate very weak price action, right? And I want to be clear, it doesn't necessarily mean that a reversal is coming, but it certainly doesn't indicate any kind of strength. And this really is the most important graphic because this really tells you why every single candlestick pattern is what it is, why a bullish engulfing is so important, why a hammer or a, whatever this is, shooting star, can be so weak or such a sign, potential sign for reversal. This is all it is, right? All that matters is the balance between buyers and sellers within one of these bars. That's all those candlestick patterns represent. And I can basically promise you all that so many people think that, if I memorize candlestick patterns, I'll be a master of trading. Candlestick patterns basically mean nothing on their own. And we'll talk a little bit more about this in just a couple minutes. But this is one of my favorite graphics. Again, this is my opinion, right? But in my opinion, you should forget about the candlestick patterns, forget about all that crap, memorizing the names of everything. This concept is the only thing that matters. That's my opinion, but this will give you the keys to the kingdom in terms of understanding every candlestick pattern anyway.
I like that, man. That's pretty impressive, Tostie. It's just like pretty much
memorizing patterns and like detecting either buying or selling and just being cautious.
I'm going to tell you right now, Norvin, and this is a message to everybody too. If, for example, it was as easy as being able to buy once you see a hammer, that would never work, right? Because you have to remember who is on the other side of every single trade you take in the market. When I buy a share of Apple, it's not Norvin that's selling me the share of Apple, right? Norvin and myself are such a small, minuscule piece of the market, right? The person that's selling me that other share of Apple is a trader working for a large fund at a desk, or maybe an AI program, right? This is not somebody who wants to lose money. It's their job to make money. And if every time there was a hammer on the chart, I bought and they sold, obviously they're going to stop selling every time they see a hammer, right? Because they're realizing every single time there's a hammer, they decide to sell, they lose money, right? It's their job to make money. So if trading was
Aren't
really
those
that
guys
easy,
called market makers, or you think they're just big institutions?
not exactly, Norman. It's a little bit different. I don't want to get into it too much right now, but market makers are not necessarily desk traders. They can be, at least at the same firm, but market makers provide liquidity. Obviously, they do end up on the opposite sides of trades, but desk traders are actually taking positions, directional positions, whereas market makers typically maintain a mostly balanced overall positioning. But we shouldn't get into that right now because we could talk about that for a while. And I also don't have an expert level understanding on that anyway. Okay, so this is basically the fundamentals of candlesticks, right? If you wanted a basics lecture, this is the end of it right here. Does anybody have any questions on this graphic? I'm trying to start drinking quietly, so Rob's can't call me out.
I know anything could happen in the market, but I've seen, you know how you see that bearish strength, the weakest one, that red hammer.
Yes, sir.
I've seen that one many times, and then it'll just like still like dump after that. And I know you
100%.
said it doesn't matter like what the individual candle itself is. You know, it
Nope.
matters what happened before and the volume, and there's all these other factors. But
100%.
yeah, so
that's absolutely accurate. You can't just look for a candlestick pattern alone and say, I want to take a trade off that. It
I
makes
used to do
no
that
sense.
like almost about like a year and a half ago when I really first started getting into this, about a year and a half ago, 2 years. That's what I was doing. I'd see those and be like, oh, that's the signal. Then I'd get crushed.
And you know what? There's nothing wrong with it. You know, you're learning, you're figuring it all out just like everybody else. And props to you for even trying to have a system, right? Some people don't even do that. So you were, I'm sure, still miles ahead of the people who are just taking trades and saying a prayer.
Yo, Tostie.
Yes, Norman.
Yo, you're not gonna believe me, bro, but today, bro, I literally woke up like around 9:15.
Okay, Norman, you're gonna have to tell me after. We gotta keep moving.
I took an XTX trade, bro. It went to 900, bro.
I'm proud of you. Let's talk about it later. I'm gonna mute you. No, I'm just kidding. I won't, but I will. All right. So, like I mentioned earlier in the announcement, some of the most important lessons that I've ever seen on candlesticks in general have come from an individual called Al Brooks. And I'm sure if you were ever in one of River's lectures, you've heard about a person called Al Brooks. And this guy, I'm not here to toot his horn, but pretty legendary day trader. He's been trading for, I don't know, probably 40 years, quit being a doctor to be a trader. So definitely is passionate about the field. None of that matters to any of us, but figured I'd give you guys some of his background because he definitely deserves the credit. A lot of the things that we talked about for the rest of the class are things that I've learned or derived from the things that he teaches. So I can't act like I figured this all out myself. And if you are interested in some of the concepts that we talked about today, I highly recommend checking out some more of his videos because he's got some crazy hard stuff to understand. You got to like hold your eyes open to stay at attention, I guess. But if you can sit through that and learn, it's definitely worth it. So anyway, had to give him some respect. So kind of as we mentioned just a little bit ago, some people may imply that knowing candlestick patterns is, maybe 90% or more of what is required to learn how to trade online, which is absolutely not the case, right? If it was this easy, everybody would do it. And so many people would be losing money that are meant to do this, only to make money, right? The institutional traders. A setup in general is composed of two things, especially when we're thinking about candlestick patterns. a signal and context. And Rob basically hit this right on the head just a little bit ago. Without both of these, you shouldn't take a trade. So for example, if you have a setup, and let's just keep the setup simple and say we have a bullish hammer, right? But we're just looking at that single bar in a vacuum without considering the rest of the chart, there's absolutely no reason to take that trade, right? You have absolutely no confluence. You have no idea what else is going on with that name. And there's basically no point for you to get involved because you're almost worse than gambling at that point. So by context, I'm referring to the fact that all bars to the left of the current candlestick that you're looking to trade should be supportive of your trade. So if you're just taking hammers in the middle of a trading range every time, you're probably going to lose money very often. You always have to have other reasons you take a trade. So for example, let's say you see a hammer at a level of support at a moving average, right? And the overall market is trending higher. Well, that would be a pretty good reason to take that trade, right? You identified maybe a candlestick pattern and a couple other reasons why the move should continue in the direction you're hoping it to. So we'll talk a lot about these ideas today, but if you don't remember anything from this lecture and you only remember the text in bold here, that's a win in my book. You cannot take any trade with a signal alone, right? Let's say, for example, the RSI hits 30, you should not be getting long because of that. Let's say, for example, the EMAs cross positively, you should not be getting long because of that, right? You have to have the context. If the name is down 99% and the RSI just hit 30, probably not time to get long, right? Could it work? Sure. Is it a good idea? No, right? Context is everything in the market. So let's talk about a couple different examples of context to start helping frame our mindset a little bit. So we're going to spend a lot of time talking about these, but basically Al Brooks, his thought is that there's 4 different types of an uptrend. The same 4 types are also covered for a downtrend, but I didn't mention it in this lecture today just because it's basically the same thing. So the graphic on the far left represents a breakout. And I think a lot of us are probably familiar with what a breakout is. And again, a lot of this is derived from Al Brooks. These are more his words than mine, so I'm not going to act like this is my own teaching because it's really not. But let's talk about it. So the chart on the left represents a breakout. Within a breakout, basically every single bar is a buying opportunity for everybody in the market. And this is very clear and very evident by taking a look at the volume that typically appears during a breakout, right? If any of you have ever paid attention to volume as a name is breaking out, any strong breakout is going to have significantly above average volume. And that's because bulls are basically looking to buy every single bar, right? They know the market is breaking out and they know there's a very high probability of continued upside, right? When you have a breakout, there's a really low chance that the market's going to reverse, especially when it's actually taking place. And there's basically no good opportunity for bears to take a short position. And that's one of the keys, right? The market is a zero-sum game. And if there's nobody really available to take the other side of the position, there's only one way the market can go, right? And if you look at the breakout on the far left, there's not really a single good opportunity to get short. Every single low of each bar is higher. So if we're looking at this on a micro scale, we're seeing higher lows, basically every single bar. And also basically every single high is higher than the previous high, except this bar right here, the third bar from the left or from the right. So really no good opportunities to get short. So obviously bulls are going to be jumping in to try and get long. And these are just introductions of each piece. The next example is referred to as a tight bull channel by Al Brooks, which is still a very strong move to the upside. As you can see, it looks very similar to the breakout in terms of the amount of momentum and power that it has, but there's a couple more pullbacks. The interesting thing about this is there are a few more opportunities to get short. As you can see, there's a couple pullbacks, right? There's some bars that are setting lower highs, but in general, it's still very tough to get short this market. So bulls can still basically buy every bar. They can buy closes of new highs. They can buy 1 to 2 bar pullbacks betting on failed reversals. So still a lot of opportunity for bulls here. And the interesting thing to note is that, if we have a tight bull channel on the 1 hour time frame, it's going to look like a breakout on the daily, right? So still overall a very strong move higher. Now, moving on to the broad bull channel. In this specific example, bulls are typically buying pullbacks and selling into new highs. And the way this is very clearly obvious is that every time we set a new high, it's very clear with the second new high, we see a pretty strong pullback and also a move back below the prior high. So in this specific example, it's a little bit more difficult for bulls to have opportunity, right? It's going to be not as good of an idea to be buying breakouts because now we're seeing bulls begin to sell the market as we hit new highs. When previously during a breakout or a tight bull channel, bulls aren't selling, right? They're holding their positions, they're staying involved. And with the broad bull channel, we see a little bit more potential short opportunities, right? Because now bears can get short the market basically every time we set a new high or when we fail to break out below prior highs, right? So decent short opportunities for bears. And hopefully you guys are starting to sense the pattern here. The final example on the right is a trading range, right? So basically we've transitioned from the strongest trend on the left to basically the most neutral trend on the right. Within a trading range, hopefully it's obvious, but bulls and bears can make money very easily, right? Especially if you're scalping. There's basically a 50-50 chance that the trading range breaks in either direction. So it's a very neutral trend overall. And it's absolutely a scalper's market, right? Scalpers are looking to long the lows and sell the highs. Scalpers are looking to buy reversals up and sell reversals down. And they're basically trading the extremes of the range. And that's it, right? At least the smartest traders are. So these are the four types of a bull trend. Kind of like I mentioned earlier, the same thing exists for bear trends. You can imagine a bear breakout, a bear bull channel, a broad bear channel, and a trading range, right? It's all the same, just inverse. The reason that I'm covering the bull side is because I think it's a little more intuitive and just kind of in the interest of time, I didn't want to repeat the same things twice. So you all are probably wondering, well, why are you covering this, right? This isn't candlesticks. And you'd be absolutely right. We haven't talked about a single candlestick, but what we have talked about is a lot of context, right? For example, if we're experiencing a breakout like we are in the far left example, we can identify this based on the first three very strong bull bars, right? We have three very strong bull bars closing near their highs. We also see this bull bar with a long upside wick. Now that we have the context, it's very evident this is probably a pretty terrible short opportunity, right? So we see that kind of potential reversal candlestick pattern, but it's not a good opportunity to get short because we're breaking out, right? And as more educated traders, we know it's not easy to make money shorting a breakout, right? You are more than likely to lose money when you're getting short the market during a breakout. And similar idea for the tight bull channel, right? We still see those kind of strong bull bars as we're breaking to new highs, right? Pretty evident. We clear new highs, we get those strong bull bars, and our pullbacks are generally not incredibly strong, right? Looking at the strengths of candles, we're not getting super strong reversals.
Toast, do you mind if I interrupt for just 1 second?
What do you got?
I've always heard River say things like 80% of breakouts fail.
Mm-hmm.
So when you're saying like getting short like a breakout is not like I'm just trying to figure out, are you talking about a different type of breakout? Or
I think so. When River says 80% of breakouts fail, I think, for example, if you look to like the broad bull channel example here, obviously we have the example of hindsight, but this would be an example of a breakout that failed, right? We set new highs and then came back and retraced back under those prior highs, which would be an example of a breakout that failed. I'm mostly referring to a breakout that's currently not failing, right? And as traders, we can't really anticipate if a breakout's going to fail or not, right? We're not here to predict the market. So if we see a strong breakout on high volume, clearing prior highs, it's probably best for us to not bet on that breakout failing because, again, we're not here to predict things. But 100% I agree with River. I think it'd be interesting for us to review a lot of the examples. In general, when those breakouts fail, it doesn't make nearly this amount of progress, right? We might make some progress on the first one, maybe even 2 bars, but that third bar, we would get a very clear reversal indicating that the breakout has failed. Oops,
So someone in the comments, someone in the chat just said something that makes sense. So like when River's trading, he's trading ranges, and when you got a trading range happening, then that's like more likely for the breakout to fail when it's ranging, then, right?
It's actually an excellent point too. And this trading range example also shows a breakout that failed, right? You have this prior high here on this bear bar, and if we look at the second high here, this breakout failed, right? We have a long wick above resistance, and we didn't close above. That'd be a failed breakout, right? You could almost even consider this bar next high also as a failed breakout, right? We tried to clear these prior highs again and couldn't close above. So that's a great point by Nick, honestly. Okay. You made me lose my train of thought, Robs. Just kidding. I remember now. So in a tight bull channel, similar to the breakout, right, there's going to be a couple less opportunities to get short, a couple more opportunities to get short. However, it's still a very difficult environment to be short, right? You can see that most pullbacks are lasting 1 to 2 bars. Even a reversal that looks very strong, right? Like this is a bear bar basically closing near its low with a long downside wick, results in absolutely zero follow through, right? And the interesting piece here is we didn't even make it above the prior high of the bar. And that same theme is basically continued throughout the entire tight bull channel. Moving on to the broad bull channel, we start to see some more unique patterns here. So this is the example where typically it's going to be most ideal for bulls to be taking positions closer to lows because most breakouts are being sold. And again, we can't predict when any one of these formations are going to happen. However, right here at this specific example, we automatically know we're in a broad bull channel, right? Once we see maybe a decently strong breakout and a longer term consolidation lasting maybe 10, in this case, bars, maybe up to 20 bars, we know we have a broad bull channel, right? We know this is an incredibly strong breakout on the time frame that we're watching. So it helps us set our frame of reference for where we're looking to take trades and the types of trades we're looking to get involved with. And finally, when we identify that we're in a trading range, this is when you're really going to want to look to be trading those reversal bars at extremes, right? You have plenty of these good examples here. Like this could very easily be a failed breakout. We have this bear bar closing near its low, then this bar here closing back above the previous high of that bar. Very obvious failed break lower, right? Decent opportunity to get long. Nice reversal setup there. Here, you have a nice long wick above the prior highs. Then this bear bar here breaks below the prior lows. We don't have volume available to us in this specific example, but if we see volume increase on the sell as well, that's another nice signal that the reversal is taking place. And here at this low, nice long downside wick. We have a bear or bull bar closing near its high. Also a reasonable opportunity to consider getting long. We're also close to the extremes of our trading range to the downside. So the big idea behind understanding the type of trend you're in is it, first of all, allows you to start understanding which candlesticks you should be paying attention to and the types of trades you should be considering taking. As a swing trader or a day trader, you're probably going to want to be looking to get long in environments like a tight bull channel or a broad bull channel. It can be difficult to get long in a breakout because there's minimal entries. As a day trader, though, you probably aren't going to be as excited in a trading range, right? That's probably going to be an environment to stay away from and forget about trying to use candlestick patterns and that sort of thing, right? That's going to be time to bring on the scalping hat or sit out if you're not so much into scalping. That was a lot. Is this idea making sense so far? I have an example that I want to cover next. That is literally from yesterday. So probably a day that a lot of people remember, hopefully.
Yeah, it's making sense.
Whew. All right. So an example from yesterday. So this is yesterday's real price action. On the left, you have the daily chart. So we can see on the daily chart, we have a decently strong uptrend. We're trading above prior highs around 627 and was looking like we were headed for a breakout, which in my opinion, probably would be an example of a failed breakout on the daily, potentially. On the right side here, we have the intraday price action, which in my mind is just an absolute excellent example of almost every trend that we talked about on the prior slide. On the left side of the chart here, pretty clearly, this looks like a breakout, right? You're breaking above this prior swing high in pre-market, and you have big bull bars closing near their highs, which again reinforces the idea that when we're seeing this sort of candlestick pattern, bull bars closing near their highs, prior highs being taken out, the probability that we continue higher is very high. However, the issue is that the risk is also reasonably high as well. Because if you're getting long on a breakout like this, your stop kind of has to be on prior lows. You don't really have any better stops. So it can be a little bit difficult to get involved in a trade like this. Then we begin transitioning into what you might refer to as a broad bull channel, or excuse me, a tight bull channel, which is made clear by these 1 to 2, in this case, 3 bar pullbacks that continue to new highs. And then here, 1, 2, 3 bar pullback, which then starts to slow down, right? So we can see this trend begin to subside, and we can see the strength in this trend begin to weaken, right? We're seeing very quick pullbacks that are bought in this specific example. Then we start to see pullbacks that aren't bought as quickly, right? We're seeing price action begin to stall. The next thing that we see is this breakout above highs fail, which is a very clear-cut indication that we are now in a trading range. So these thoughts alone have to be going through your mind as price is showing up on your screen, right? You have to be considering what is the current trend and also what is the strength of that trend. And you can use these frames of references in terms of the breakout, the tight bull channel, broad bull channel, and trading range to understand where the market is currently at. So throughout all of midday, we had a trading range, which again is characterized by failed breakouts and basically a 50-50 chance that price goes either way. And ultimately, we closed the day with a breakout to the downside. And very interestingly, we got a bear bar closing near its low on elevated volume. Automatically, that's our signal that a bear breakout is beginning, right? And the most interesting part is this is right at the low of our trading range. We retest it, but again, right, some people might consider getting long on this bear or bull bar closing near its high, but we can't be predicting what's going to happen, right? We can't predict a failed breakout or failed breakdown. We have to react to what's on the chart. And if we're day trading this or if we're scalping this, right now, the chart is telling us we have a breakdown on high volume and a retest of that same prior low, right? This isn't necessarily a bottom signal in this case, right? Because the trend is now shifting to the downside. And then ultimately, trend continues lower, and we have this tight bear channel, right? Each pullback lasts 1 to 2 bars. And again, right, you might be tempted to buy this very long wick to the downside. It's on high volume. It looks like it could be a reversal. It's off of this prior high as well. So you might be thinking, okay, it's an opportunity for me to buy. But the problem is there's no proof that this is a reversal at this point in time, right? If we try to get long on what could be, a hammer, it's just a prediction, right? It's just a complete guess. We have no confidence in saying that this is a bottom because the trend is down, right? At this point, we're just looking for a bottom. We're just bottom fishing, basically. And ultimately, this trend continues into new lows. So the point being, and why we cover this entire example and this entire concept is there's a time and place to look for specific candlestick patterns. When we're in a strongly trending environment, such as a breakout or a broad bull or tight bull channel, I keep getting them mixed up, we're not looking for a potential reversal, right? We know the trend is strong. We're looking for opportunities for continuation. We're looking for opportunities to get into the long side. As we begin to transition into a broad bull channel, our mindset begins to shift, right? Now we should start to think, okay, buying highs is probably a little risky. Buying breakouts is a little bit risky. It's time to start considering trying to get in long at the lows, or maybe, if depending on the type of trader you are, you sit out. And finally, once we get into a trading range, you have to make that same decision again. Are you the type of trader that's going to get involved in scalps, right? Because trading ranges are the ideal place to begin looking for these types of reversal bars because the market has a 50-50 chance of going either way. And both bulls and bears are looking to make money in a trading range. And this same idea is basically duplicated for bearish trends and bearish environments. Again, I like to focus on the bull case because I personally find it a little bit more intuitive, but it all applies to bearish environments as well. Johnny has an interesting question. Is there a way to easily identify trends? For me, I think if you print this example out, if you print this example out and watch the prior lecture, I think you will have a very good grasp on the trend of any market. Yeah, I'm a little bit biased, but I think those are really all you need to have concrete proof on what the trend is and how strong it is. I've been talking at you all for probably 30 minutes straight at this point, and I want to take a quick pause. What questions do you have? What comments do you have? What can I clarify further? I think this is one of the harder things that I've talked about, and even I'm stumbling over my words trying to find the best way to deliver it. So I want to take a quick pause and see, what are your guys' thoughts? What are your questions? Well, what can I clarify further with the rest of our time tonight?
Yo, Tostie, I have a question, man. So I'm really good at detecting like strength on like either good companies or bad companies, and I have two perfect examples, like Celestica and then Lululemon. So would you think I'll be bad at bottom fishing Lululemon for the long side, or just like stick to relative strength as like a Celestica name, or a yeah like or like a Nvidia or something like that, you know?
Mm-hmm. It's a good question, Norman. My opinion is that in general, especially in the market environment that we're in, I want to focus on relative strength. But I know for you, you probably should be more of a long-term investor. And in general, long-term investors are looking for areas of value, which I don't know anything about Lulu, but I would argue that it's at a reasonable spot on the weekly. It's basically right at those weekly lows, a make or break spot right around 220. It doesn't look great to the long side, but as a long-term investor, when it looks the worst, can be some of the best spots to buy. So I don't hate either one of your ideas. I just think you have to treat them a little bit differently. Like Celestica is a name that you could probably be a little bit more flexible in terms of a short-term trade.
Buying
Whereas
every day.
Lulu, yeah,
Buying
Lulu is not a short-term idea.
Yeah, and they want to sue Costco, so I don't know, like, you know, if it's a really good idea to long it. Like, I've been talking to like a couple people, and they're like, I guess they're saying they might go to 140, but I don't know. I don't know.
I couldn't tell you, Norman. We didn't get any questions from anybody else. So does that mean everybody has a full and complete understanding of everything and is ready to implement it all?
I kind of got a quick little question to throw at you here.
Yeah, what do you got?
It might be a little bit of an opinion thing too, but what time frame do you normally look at for these kind of patterns? Like just like 15-minute, or is this more of like a bigger time frame? Where do you normally
Yeah,
find the most value?
yeah, it's an excellent question, Nick. For me, I'm typically more focused on swing trading, whereas Al Brooks is more focused on day trading. For me, I'm always focused on the daily and weekly charts. And just like any pattern, just like any sort of piece of technical analysis, it applies to all time frames. So my thought is always the higher time frames because I'm more of a swing trader. If you are more focused as a day trader, my preference would be to use the 5 and 15-minute and search for these same ideas. And if you're looking to follow Al Brooks and River as well, they would preach the 5-minute, and I would generally agree with them.
Gotcha. Okay.
I
Thank you.
hope that answers your question.
Yeah. No, that was great, man.
Cool.
Hey, Tostie.
Yeah.
Hey, so just following up with my trend question. So like when I see this frame right here, like literally in my mind, how I don't know if it's I just have to unlearn or something, but like the breakout type bull, broad bull trading, so it literally looks like you're going down the frame. So like time frame. So like breakout would look like an hour chart versus a 30 versus 5 and versus a 3 or 1. Like that's why I'm just like kind of confused, because I'm like, how do I identify? Because clearly one can see a trend, be like, oh, that's bullish, that's very, but like have a bias.
Right.
And I know we're supposed to like trade what the market gives us, not like based solely on the bias, which I understand. But literally that looks like a daily, that looks like an hourly, that looks like a 30, that looks like a 5 to me. So it's just like that's the part where I'm like, how do I, like, is there, like, what do you do personally to be like, okay, this is probably a bullish or probably bearish in the moment? Like, is it per time frame, or is it like, do you just have that, oh, it's bullish on the higher time frame, so I should look for only bullish like calls, or like when you're like context wise. So not just like your slide where it says not the context, you need context and the I forgot what the other one was.
Context and a signal.
And a signal. So
and
like,
context.
yeah, how do you put those two confluences together? You know what I mean?
Mm-hmm. Yeah, so I'm going to try and answer both questions separately. The first one related to timeframes, I understand why you have that perspective. I think probably part of the reason you might feel that way, and I'm sure somebody else feels the same way, is that this chart on the left like doesn't give much information. It's basically 10 bars, whereas as we move further to the right, we get more and more price action. So intuitively, it would make sense if the far left time frame is the daily, then the next one is the hourly, then the next one is the 5 minute, right? I 100% don't disagree with your thought. The one thing that I want to make clear though is that every single one of these patterns are possible on every single time frame, right? It's not like you'll only ever see a broad bull channel on the lower time frames. And I wish I had a bunch of examples collected, but I don't. But I guarantee if you look through 10 different charts in 10 different time frames, or excuse me, let's say 10 different charts and 5 different time frames on each of those charts, you'll probably find almost one of each in every single example if you look far enough. With that said, I do understand why you might more intuitively think the left is the daily. The best example I have to prove you wrong is this one that I already prepared, which this very easily could be a daily chart, these first couple bars, but it's not, right? It's a 5 minute, but obviously I don't have a bunch of different examples to tell you why you're crazy. But I get it, Johnny. It makes sense. Does that answer your first question?
Yeah, it does. And at the end of the day, like I see where you're coming from, and obviously like I get, everything happens to everything, but it's just like, for example, I guess this is my thing that I'm trying to like overcome. So say that we're on that 5 minute chart, and then that that bullish trend starts, which is great, okay, and it starts pulling back, and it's just like when you're in a trade. So like now, obviously, hindsight is 2020. You're like, oh, that would have been a nice, bullish, trending, tight, whatever. But like, say that right in the middle, like it's pulling back, like right in before the high, the second. So on the so there or there, I guess either way, it's just like when you're in the trade in the moment live as the candles are printing, it's just like, how do you, like, what would you do? You know what I mean? It's just like,
in terms of what, like entering the trade, managing it,
or just like reading the trend. So like I would have been confused at that second one right there. I would have been like, oh, is it reversing because it broke the lower previous higher low, and it's like, is it going to continue downtrend? That red candle, I was like, oh, that's probably a pullback, and then pull a fib on it and be like, oh, that's probably a 0.238 or like 3 4, and then like I would have, like, obviously wait for confirmation. I wouldn't have pulled the trigger, but realistically I probably would have pulled the trigger. So it's just like, I think it's like trying to figure out, what Nick said, the calls at resistance, and then freaking like, puts at support. It's just like, how do you know when you're in the trade as it's printing, like how do you determine which bias, like how do you read it? You know what I mean?
Yeah, I think you've honed in on the one question that can never be answered in trading, right? It's not an easy question to answer, because if it was, it'd be very easy to make money trading,
Oh
right?
yeah,
And we
that's
all
true.
know that that's not the case. With that said, though, the best answer that I can provide you today is that, first of all, we have the benefit of hindsight, right? We can look at any chart today and say, look where you could have got long, look where you could have got short. Don't let that cloud your judgment, right? Because I can tell you what the perfect entry was, but would I have taken it? Probably not, right? I could tell you all day you should have got long here, here, and here, and I wouldn't have nailed any one of those bottoms, right? So that's the first and most important thing that I want to just mention before we go too far into this example. The actual way that you could at least have an inclination that you shouldn't be too confident there's a reversal taking place is that we're still setting higher highs and higher lows, right? This high here is still a higher high compared to the prior high, and this low here is still a higher low compared to the prior low. Now, again, we have the benefit of hindsight in our favor here. However, the one thing that I would always recommend to everybody is trade candles that have closed, right? If you traded while these bars were still open, it was probably looking a lot worse at some points in time, right? This bar here was probably looking like a bar that was breaking down. But now once we see it closed, we can see, okay, this low held, right? And once we wait for the next bar to close, we see, okay, we closed back above those prior highs. And then now we see 2 more bars close, and now we're holding those prior highs. So long story short, right, the trend is still up. So we have to let our bias be in that direction wherever possible, especially when we've made a move lower, and only trade closed candles. That is probably the 2 best pieces of advice that I can give. I guess the last thing that I would say is that confluence is always important, right? So we're not just trading the trend. We're also mindful that this is a prior high and it's an area of potential support, right? I'm also probably sure that if we pulled some EMAs up, they're probably trending positively, and we probably came right into them. And we can even pull the chart up and take a look really quick and see if that is true.
Waiting for candle closes has helped significantly for me.
I bet. Yeah, trading unclosed candles.
I got that. I got a list of trading rules that I have on my desk here, and that's one of them. Wait for candle closes.
Yo, Tostie, you think Doku is
Hang
a
on,
good
Norman.
swing?
Hang on, Norman. We're in the middle of this one. Give me a second. Okay, Johnny. How do you feel about that? Right now, we can see we're just right into the EMAs. So if you're shorting into rising EMAs in an uptrend, you're making a mistake, in my opinion. Right, and again, we have the benefit of hindsight to help us here, but I don't see a reason to be short.
No, the first one that you pointed out, that one right there, where it broke the VWAP, broke the cloud, broke.
Here.
And it broke the previous, uptrend lower, like higher low. So I guess that would have been confusing for me. But I see that, and I really like the thanks for the tip, the waiting for closed candles, because I don't know, my trading style was kind of like, when you break a high, when you break a low, it's just like, trying to like continuation. But I think the waiting for candles close, I think I'm gonna try like start implementing that. But like for example, right there, I would have waited for the red to close. After that pullback, I would have thought that's probably a pullback, but
Johnny, I'm going to tell you right now, I agree with you. If we just saw this, it would really look like a breakdown, and we would have been wrong, right? We're going to be wrong when we're trading. The important piece is that maybe you shorted when this bar closed below prior lows, but you damn well should have been closing that once we closed back above that level. And you probably should have swapped long, right? If you're trying to trade short-term moves like this, you need to be ready to turn on a dime. And if you're not, you shouldn't be trying to trade that. So I agree with you, Johnny. You definitely could have gone short right there. I could maybe say the EMAs are still trending positive, so that could have kept you out of it. Maybe it wouldn't have, right? This is a short. You could short this, right? For sure. But you should be able to stop out too, right? You should know this is the main reason you're in the trade. You should be ready to stop when you're back above that level. And once you see that level hold, you should be getting long as well, right? Especially if you start to pay even a little bit more attention to maybe we're breaking this minor trend, we're holding that, popping back above the EMAs, holding this prior low, EMA slipping positive, maybe a little bit of volume on the hold as well. So anyway, I don't disagree with you, Johnny. There's going to be losses. If this was perfect, we would all be very wealthy, but it's not, right? Nothing's going to be perfect.
Thanks, Tostie.
My pleasure. It's an excellent question, Johnny. You're on the right track.
I think it's also tough when you're at all-time highs because you can't really have the benefit of looking left and like draw on that support and resistance,
It's absolutely true, Nick. 100%. Yeah, my best way of looking left or supplementing that is I like to run fib extensions when we're at all-time highs, but I do that, and I plan for basically psychological levels. So on the SPY, it would be things like 630 and 640 and 650, and looking at the SPX for 6,300 and 6,400 and 6,500. And that's all you can really do. But again, we're not in the game of predicting, right? All we can do is react to rejections at those levels or wherever they end up showing up. ZT asked, do the colors of candlesticks matter? No, I could make the colors of these candlesticks blue and gray, and I'll just do that now. And it still means all the same thing. Oops, that didn't do what I wanted it to. Long story short, the color of candlesticks are something that you can set yourself.
Do you think that person's asking literally about the colors, or like what the red and green ones mean?
Robs, now that you call me out and ask me that, you might be right.
Because I have green and white candles. I use white candles in place of the red. on my charts. I
Mhm.
just like how it looks with the black background. But yeah,
I don't
I
know,
think
ZG,
that's
maybe you could clarify. Yeah, maybe I answered the easy question and then I wasn't supposed to. So uh, the question that I answered is the candles on your chart don't matter. You can make them whatever you want, and they mean the same thing. Just it's up to you. But um, if you're thinking about like a bull candlestick versus a bull candlestick or a bear candlestick, yeah, that definitely does matter. Um, Errol asked, "What are my thoughts on Hike and Ashy?" Honestly, I don't really have any thoughts. I don't really know anything about them. I don't know how they're determined really. I know some people like them, but I'm not super educated on them, to be honest with you. So I wish I knew more.
I have a
15 minutes.
question.
Yes, sir.
So this morning I opened on the SPY at I think it was like 9 o'clock.
Mhm.
So once it got in that channel, I saw it dip and get a new like my problem right now is I always sell before the breakout. So I see this lower low, but then it just channels up.
Lower low where? Here?
So so like I opened at or I got in at like 9:05.
Okay.
And then
That's sorry. What time zone are you in?
I'm in Texas. So I
Okay,
think
so
that's
you're 2 hours ahead.
yeah.
So you're right around here.
So I'm right there, and then you see it go up, and then you see that red candlestick to the right of it.
Hmm? This
No,
one here.
sorry, not that one. Like
Up here?
what time is this? My 11:25. I don't know what that would be for you.
7:20-ish, right around here. These two red
Uh,
bars.
it's like more like once it hits that bottom of the.
Oh, sorry, you're 2 hours ahead, not three. So wait, is it over here?
Keep going more right.
Here.
Nah, no. Like at the
Damn, I'm
bottom.
tripping. Wait. Dude, I still can't get it right. Wait, 11 minus 2. Is it, you said 11:20?
Yeah. So
God damn, I'm
11:20,
so sorry. All right, right
11:25.
here. All right, I figured it out. It took me a little
Yeah,
bit. Right
yeah.
in this
That
area.
so
Sorry, I
that's whenever
apologize.
I sold right there because I was like, okay, it's getting a lower low, and
Yeah,
then
like lower
it
below here.
and then it breaks out.
Yeah, Max. Honestly, I think it's the exact same situation that we just reviewed previously, where I don't think you're really wrong for selling here. I will say the one issue is that this is a mini trading range, and we talked about earlier. Trading ranges, generally speaking, are going to be tough environments. You're going to want to scalp long the lows and short the highs. Um, I don't really blame you though for shorting here. It doesn't look bad. You have the prior downtrend from earlier. Um, yeah, I would give you, Max, the same advice that I gave the last person. I believe it was it Johnny, which is that sure, yeah, I don't blame you for taking the trade. I don't think you're wrong for it necessarily, but if you didn't stop out right when we made it back above that level, I do think you're wrong. Or if you added more to the trade in the middle of this bar when it looked like it was headed back lower and you didn't wait for the close, I do think you're wrong. But I don't blame you for taking the trade. But again, if you're taking trades like this, you should also be taking the long when we break above here or when we pull back and retest this prior low here that we set earlier in the day. But fundamentally, what are your thoughts on that?
Okay, that
Does
helps.
that help at all? Yeah.
Yeah, no, that definitely helps because my problem is I'll be looking at like I just see a dip and I'm like, oh shit. I'm like, I gotta get out of
Yeah.
that.
Yeah. And I have to ask the question, do you typically have a plan in terms of where you'll take profit and where you'd stop out before entering the trade?
I mean, I kind of just I'm new to it. I'm new to
Uh-huh.
trading. I've probably been doing it
That's
for
okay.
like a month. Um,
That's okay.
I've been trying to like get a better plan and gauge
Hmm.
where I should enter and sell.
Hmm.
That's like this whole class right now has been very helpful, but I just wanted to know where
Good.
you would sell it.
Good. Yeah, I think you're on the right path. Hopefully you don't take this as a personal attack, but you shouldn't be getting in any trades that you don't have a plan for, because it's going to cause those emotional reactions, right? It's going to cause where maybe you're down here and then you see it come back up and you're like, oh God, like now what? Now I'm down. Now what? When really, in my mind, it's a simple decision. Obviously, again, we have the benefit of hindsight, and this could easily fail again. So it's easy for me to tell you exactly what you could have done. But again, take it all with a grain of salt. But if you did have a plan going into this, and your main reason for getting short was this breakdown, and you see us reclaim that level and then hold above it for at least 1 to 2 bars, probably time to get back out and reassess. And you got to have that plan before you go into the trade. Reason behind that is because it allows you to basically cope with the fact that you might lose. And that might sound silly, but as humans, it can be very difficult for us to accept the fact that we're wrong. Some of us can be very stubborn, especially when money is associated with the situation as well. And if you have that plan going into the trade and you're prepared for the fact that you might be wrong and what you'll do and how you'll know when you're wrong, in my mind, it makes it a lot easier to manage the position when it comes to that.
Okay.
Hey, Toasty, I don't know if you could real quick, because I know there's a lot of new people, and going back to when River says look left, but if you go and like chart a couple levels from Friday and then look at how it applied to today, I don't know if that might be helpful for some people.
Yeah, like Friday intraday, you think?
Yeah, just kind of like some of those levels.
Yeah, it's a fair idea. Let's
That's
do it.
fire, right? Yeah.
Yeah.
I took one out of River's book, and I get all my levels that I trade around from either the weekly or the daily chart. I don't get any levels from no 5 minutes, no 15 charts, none of that.
I don't
find
typically either,
those.
but it might be a fun exercise. So let's take it for a spin.
Yo, Toasty,
We'll just
tell them that's why you're not a day trader, because we're swing traders, because we don't have to be
that's
stressing, huh?
that is also a fair point, Norvin. I don't typically day trade myself. I like to not stress, so I am more focused on the daily and weekly. But those are probably the 3 levels that I would take if I'm forced to look at the 5 minute, and we can kind of see how they played out today. So that ended up being our pre-market high and our pre-market low as well. And once we made it above that spot from Friday, obviously a big move higher, a little bit of support there in the afternoon as well. Yeah, we will have these are honestly excellent questions, guys. I
Yeah, and
don't want
sorry,
to not. No,
that
you're
was
fine.
yesterday,
You're fine.
right?
I don't know. Oh,
If you bump,
yesterday. This
yeah, if you
is
bump it over
yes.
to today,
Sorry.
Yo,
Oh
Toasty,
yeah, even
can you pull
better.
up Doku?
No, Norman.
Potential swing idea, bro. Come on, give us
We'll talk
that
later, bro. We'll
2000
talk later,
banger.
bro. Shut up.
yeah, I just kind of wanted to. That might help out some of these guys with knowing
No, I
those
mean
levels.
these levels actually are pretty solid. Funny
I was
enough,
about to
we
say
just
that bottom level played out perfect, pretty much.
yeah, that's
Held it,
you know, it,
rallied off it a little bit.
yeah. Look at Nick.
In a
He came into
contractor, though,
today
you'd have to
prepared.
be
That's for
careful.
sure.
Yeah, I've been doing it with Delta Airlines lately. It works pretty decent.
I like that. It's awesome.
I have noticed that too, bro. Like sometimes levels from like 2 or 3 days prior, not they tend to like. I noticed they tend to like work out the next like couple of days, depending on
This is
if
going to
there's
sound
new.
kind of corny, but charts do have memory, right? It doesn't matter how long ago the level's from. If it's 5 minutes or 10 years or 20 years,
Dude,
levels from the past
levels
typically end up as support in the future. That's for sure.
I got levels on Bank of America from like fucking the 90s, bro.
My favorite level is on T from 99, I think. Holy crap, T hit 29. That's crazy. This is my favorite chart and one of my favorite trades I've ever taken, and I'd probably talk about it more than I should. Let's see if I still have it. I don't. It's also hard on the laptop. I think it's missing some stuff for some reason. Anyway, this is my favorite level on T right here. 19, I can't even see the chart. I have too many things open. 1996, 1995. Crazy stuff. Anyway, guys, I think honestly a lot of the questions that you guys asked tonight are incredible. I think a lot of you guys are asking the right questions, which is really, really cool to see. It's some of the best questions I think I've ever gotten. I want to reassure you, and I don't want to rush through the questions that you have because I think they're great. A lot of what we're going to cover in the continued courses or classes should answer a lot of these questions. But in the meantime, if you have anything that you want answered, you guys can feel free to send me a DM at any time, and I can give you a little bit more of the attention that you deserve and not have to rush through them as much. But with that, I think that's going to do it for tonight. Again, thank you guys so much for being so engaged. This is some of the most conversations we've had in the class, and I think it's been incredible. There were even a couple slides that we didn't get to tonight, so I'll need to think through how I want to deal with that in the future. I thought I didn't have enough slides for tonight, and turns out I had too many. But anyway, guys, I appreciate it. Please DM me. A lot of you guys had great questions. Nick, Johnny, Robs, a lot of you. So reach out if you want to talk more. I'd love to continue the conversation. Or hopefully I see you next week. But I think that's going to do it for today, gents and ladies.
Appreciate you, Tostie.
Hey, thank
And
you,
everybody
sir.
else.
Have a wonderful evening. Appreciate you.
Yeah, you guys do the same. Yeah, it's been a pleasure, everybody. Thank you so much. I'll see you guys all on the next one, and reach out. I'll be responding to messages this week. So let me know. See you guys.